I know that there are still a number of people that are still apparently involved in traffic congestion and getting here, but we're going to go ahead and get underway so that we can stay on schedule. So good morning again and welcome to the 2007 Business Forecast Luncheon. My name is Dan Worrell. I'm Dean of the Sam M. Walton College here at the University of Arkansas, and it's certainly my pleasure to serve as your Master of Ceremonies today. It's really great to have well over 1,000 people here today for our 13th annual Forecast Luncheon. And I certainly extend a hearty welcome to each of you that are here today. And given our time constraints that we have, I strongly encourage all of you to begin eating now, and I can tell by the noise that most of you are. So I hope you very much enjoy your meal. Our event today is offered in conjunction with the National Association for Business Economics and our own Walton College Center for Business Economics and Research. I would like to thank Marianne Greenwood for her assistance in securing this year's speakers. Marianne, would you please stand up? Marianne. And also a very special thank you for his assistance in launching the Forecast Luncheon 13 years ago, Dan Grubb. Dan, would you please stand up? There he is. We have many distinguished guests with us today, and I'd like to recognize our 2007 sponsors. This program really is made possible because of the generosity of so many corporations and individuals. All of the sponsor tables have a red ribbon that is attached to the sign on their table. So I would like each of the sponsors to stand as I call their company name and ask that they remain standing and that the audience hold their applause until all the sponsors have been recognized. Arkansas Capital Corporation Group, Arkansas Department of Economic Development, Arvis Bank Group, Charles Schwab and Company, City of Fort Smith, Cooper Communities, Dan and Jody Grubb, First Security Bank, Cruz and Associates, Gaddy Investment Company, Garrison Financial Corporation, George's, Greenwood and Associates, Legacy National Bank, McKee Foods Corporation, Mitchell Williams, Seelig Gates and Woodyard, Moore Stevens Frost Financial Group, Rebsman Insurance, Regions Bank, Southwestern Energy Company, Sweetster Construction, Swepco, Tullis Taylor, Sartain and Sartain, Walmart, Sam's Club, Wright, Lindsay, and Jennings. Let's give all of our sponsors a big round of applause. I also would like to welcome some key people from the University of Arkansas that are here with us today. And I'll ask that each of these folks stand as I call their name, and once again ask the audience to hold the applause. University of Arkansas Board of Trustee member Charles Charlo, University of Arkansas Chancellor John A. White, Vice Chancellor for University Advancement David Gerhardt, Vice Chancellor for Academic Affairs and Provost Bob Smith, Vice Chancellor for Finance and Administration, Don Peterson, Vice Chancellor for Government and Community Relations, Richard Hudson, and the CEO of our new Arkansas World Trade Center, Dan Hendricks. And I wanted to mention regarding the World Trade Center that if you're not aware of where it is, it's directly across the street. So it's really just a short walk from where we are this morning. So if you can, it'd be great if you could take a look at that sometime when it's convenient for you. We also have representatives from U.S. Congressman John Bozeman's office, and I also would like to recognize former U.S. Congressman Paul Hammersmith. How about a round of applause for these people? I would certainly be remiss if I also didn't recognize the Walton College faculty and staff members are here today. Would the Walton College faculty and staff who are sprinkled throughout the audience please stand? How about some applause for the faculty and staff? Thank you. And also, thanks to our sponsors who've made it possible, we have a number of our students that have joined us today. Students, would you please stand and be recognized? Our students. Some applause for them. And you're about to meet one of our students here in just a moment, because each year at the luncheon, we ask attendees to make their forecast regarding key economic indicators for the year end. And to announce last year's most accurate forecasters, I would like to introduce to you Weston Rice, who's president of our club, Economique. Weston is a senior economics major in the Walton College. Weston?
When they asked me to speak in front of this many people, I didn't think it'd be any big deal because I've spoken to this many people, but it's a little different than reading the lunch menu over the intercom at Little Rock Central High. Anyway, each year at Business Forecast, we invite you to forecast the values of 15 economic indicators for the upcoming year. These variables include the growth rate of real GDP, the inflation rate, interest rates, exchange rates, unemployment rates, commodity prices, the trade balance, the federal budget position, and the Dow Jones Industrial Average. We then give awards to the top 3 overall forecasters and another to the best forecaster of the Dow. 342 people participated in last year's forecast. We will first announce the overall contest winners. And as we call your name, please come up here. Our 3rd place overall forecaster is Mike Morgenthaler with First Security Bank. Mike. Our 2nd place forecaster is Clinton Bennett of Dallas Real Estate Services. And the best overall forecaster for 2006, Jeff Olson with the North Arkansas College. Jeff. Now we turn the contest that forecasted the Dow Jones Industrial Average. Our contest participants from last year produced a consensus forecast that the Dow would grow 2.8% to 11,014 at the end of 2006. In fact, the Dow finished 2006 at 12,463, growing by 16.3%. Our contest winner, Ed Clifford with Bentonville Bella Vista Chamber of Commerce, was off by just 0.3% with his prediction of 12,500. Ed. Congratulations. And boys and girls, don't forget to fill out this year's contest form. Make sure to forecast all 15 variables to be eligible for the overall forecast awards. And finally, please make sure to fill out all your contact information, including your email address, in the questionnaire on the reverse side of the form. Thank you.
Thanks, Weston. You did a great job. I wanted to ask you to be sure to please find the form for next year's contest at your table, and don't forget to fill the form out. And we also have at your table an evaluation sheet for today's program, and we're very much interested in getting your feedback so that our 14th annual conference will be even more exciting than this year's. Now it's my great pleasure to introduce to you one of the University of Arkansas's outstanding alums, Ms. Julia Peck Mobley. She's Chief Executive Officer and Chairman of the Board of Commercial National Bank in Texarkana. Ms. Mobley is also President of Commercial Bank Shares Incorporated, which is an Arkansas bank holding company. She develops real estate projects and manages timberland operations in southwest Arkansas. She serves on the Walton College Dean's Executive Advisory Board and the Arkansas Business Hall of Fame Selection Committee. She also has created the John A. Dominick Endowed Scholarship for an exceptional Beta Gamma Sigma student and she also established the Honors College International Experience Endowment in the college. Ms. Mobley served on the University of Arkansas Campaign for the 21st Century Steering Committee and Women in Philanthropy Committee. Please help me welcome Ms. Julia Peck Mobley. Julia?
Well, this is great to come up from lower LA to northeast Arkansas and see this marvelous crowd. And they told me that I had to keep this at a pretty close clip today, and that's what I'm going to do. So I'm going to start right in. What I want you to do is look on the tables, and you've got green cards. And this is where you're going to have an opportunity to ask the panel questions. So if you fill them out, they'll give them to me later. I'll pick out a few, and we'll ask the questions. I want to thank Dean Worrell and Marianne Greenwood for asking me to do this. It gives me a chance to come up and see what this part of the state is doing. And this part of the state is really leading the rest of the state, so I thank you for all of that. It's my pleasure to introduce Mr. Paul Horn, who will present the outlook for the international economy. Mr. Horn is an independent market economist based in Alexandria, Virginia, and Paris. In 2001, Mr. Horn retired as the London-based European equity market economist and as a managing director of Smith Barney of Citigroup. He joined Smith Barney in 1975 in Paris, a chief international economist and a member of the Investment Policy Committee. He holds a Bachelor of Art from Yale University. Please welcome Mr. Paul Horn.
I was wondering to myself whether or not I should make exact that that's Alexandria, Virginia, and Paris, France, but then she mentioned France. You know, about 3,000 miles from here, right at this moment, is a gathering of the world's finance ministers, central bank governors, and the captains of industry in the Swiss Alps in a small village called Davos. What they don't know is that the real reality, the real economy, is represented here in what I would describe as Davos of the Ozarks. And I think really they could probably listen carefully to what you all think about the international economy in particular. I want to make a particular point today about the international economy. I'm quite positive. I happen to agree with my longtime friend, John Sylvia, that things look pretty good here in the U.S. and internationally, but I would like to make a strong case for what I would think is a new paradigm in the global economic situation, and which means that the United States does not have the burden of continuing to stimulate international growth as it has primarily since 1995. Most of the incremental growth outside of the United States between 95 and 2002 came from U.S. consumption. And I think it's important that we know that this has changed. What I'm driving at is the importance of the developing Asian economy. China and India and the smaller countries in Asia are gaining an increasing share of world GDP, and our share of GDP is declining. That may strike you as a bad thing, but in fact it's a very positive thing, because they, what I describe as CHINCO, China, India, and Company. CHINCO has growth rates are in the region of 8 to 10% per year average, and they must have that kind of a growth rate because China, for instance, has so many people coming in from the farms into the cities, into the new economic areas, that they must generate, and this was told to me by a very senior Chinese official very recently, they must generate 19 to 21 million new jobs net per year in order to keep political stability continuing. So they don't have a choice, and I think India is somewhat similar, and that is that they must continue to maintain an 8 or 10% growth rate. As they do that, and as the developed countries, the United States, Europe, and Japan, grow at a growth rate which is about 1/3 of that, the Asian CHINCO and Company continue to gain share of the market, and therefore they become the main support or principal supports for the international economy, and that makes a great difference. I think, however, I think the world economy owes us, the American consumer, a vote of thanks for our shop and drop habits of consumption. We have done an excellent job of keeping the economy going. And at the same time, I think we owe Chinco a vote of thanks too for doing so much to produce the low-priced cornucopia in our stores. And we, and I'm sure the Federal Reserve must be grateful to them for helping to maintain low-cost prices of products and services to keep us, and dare I say, on target. Let me move on with some numbers to accompany these principal international trends that you see on the screen. At least I think you should see it on the screen. There we go. Just a few numbers to accompany this about Chinco. The world's GDP measured in purchasing power parity is about $65 trillion. It was, of this, about 52% was represented by the industrialized economy. The rest was total emerging markets. Now, in the last 5 years, the split between the developed economies and the emerging economies changed in favor of Chinco and the emerging economies by 5% of global GDP. My guess is that within the next decade, we'll see another 5 to 7% shift towards the emerging markets, notably China and India. What this means, too, is that Chinco will be the marginal bidders for energy, for metals, because they must have energy and metals in order to continue this growth rate, which means even today they are the top marginal bidders for oil, for gas, for copper, and for even steel. Another factor which is associated with the international outlook is that we've had, because of this extra growth coming from Asia, because of the high growth that we've had in the United States and elsewhere, we've had a global liquidity tsunami, I call it, which means that we have money effectively up to your ears. If you feel you don't have enough of that tsunami of liquidity, you have a lot of company. But in effect, there's an awful lot of liquidity out there. Global leading indicators around the world point to continuing good growth this year, unlike 6 months ago when it looked as if we might have quite a significant slowdown in the world as a whole. What are the principal risks? I would say the housing market and the derivatives financial structures associated with those derivatives. Let me get on to some more specifics. In this chart here, the industrialized world slows down but grows. The industrialized economies have, over the past few years, moved towards an average of about 2.5% to 3% growth, and it looks as if they will continue that this year and in the next 4 to 5 years. The European area, most of us are used to thinking of Europe as being very slow growing, low employment, but Europe has actually been picking up to all of 2.25%, 2.5% recently, and will continue to. Japan's GDP has slowed down a bit from its peak rate in the middle of 2005, but it is still doing very well after a decade-long recession, and we would expect that to continue. Developing Asia, as I said before, notably Chinco, grew 8.7% on average last year and may grow around 8 to 9% this year. World trade, something very interesting. World trade was up 9% last year. It's been growing around 9%. That's about double the rate of GDP growth in the world, and it's likely to continue as well. Look at this chart on emerging markets, now the global engines, as I say. Global private consumption. You will notice how high the line is on the left-hand chart for emerging markets private consumption. This is continuing to rise as the Asians, Chinese, and the Indians save less and less. Their household savings rate had been 2 years ago 52% of global income. It's now coming down fairly rapidly. They're at about 45, 46%, and their consumption is growing. So what we hope is that their consumption will lead to more Walmarts, more Targets in China, in India, and spread. Their imports, as a result of this, are also rising rather rapidly. Investment, you'll notice the very big difference between the industrialized countries' investment line and that of the emerging markets. And of course, they need to invest a lot. They need to invest even more in order to continue the rapid rate of growth that they have. However, I would point out that their 40% annual savings rate, as that comes down and more of that goes to consumption and to investment, there will be less to lend to those countries that need to borrow foreign capital. Our savings rate, our national savings rate in the United States is only 13%, so that's why we have to borrow a lot of these Asian savings. Another factor involving the international economic scenario, of course, is the global oil balance. I feel that there has been a basic change, almost as important as Chinko in the global growth, and that is because of Chinko's demand for energy, we've had an unexpected increase in the demand for oil, gas, coal, and other forms of energy that was not foreseen as recently as 5 or 3 years ago, especially by industry, which thought that global demand would continue to grow for energy at a relatively slow rate, and therefore they didn't invest. And so we've had global demand growing very rapidly while supply, oil fields, gas fields, and the infrastructure grew very slowly indeed. And as a result, we are now down to, this chart shows spare oil production capacity. Typically, we had 3 to 5 million barrels a day of excess capacity, which would make up for losses due to maintenance outages or terrorist acts or wars, for instance, in the Middle East. Today, that is inadequate to deal with those outages, so we need more supply. Given the increased demand and the limited supply, it says to me that we will have continuing rising energy prices. Non-fuel commodity prices, notably metals. As you'll see, there was a long period where prices were below the long-term trend, and then beginning in 2004, they rose very sharply, in part because of Chinko's demand for metals of all sorts and non-metal commodity prices. I think we have probably reached the peak on that. There was a substantial component of financial speculation, but in my view, we will never come back to below that straight line there, back to the slump prices of the 1990s. And I think the long-term trend will be to rise. The next chart refers to this liquidity tsunami, which I mentioned earlier. This was caused by a number of factors. High GDP growth during the 1990s and since 2002. Asset inflation, financial assets. We've had an absolutely remarkable stock market since the beginning of 2003. The housing market, not only in the United States, but in Europe and in Japan, believe it or not. And of course, the diversification of risk around the world through derivatives, the securitization of risk, which has given people made them less afraid of risk and inclined to take more diversified risk. And as a result of this, we've had a rate of increase. The black line is the line for global liquidity as measured by M2 and M3 money supply growth. The black line has been running for the last 3 years at roughly 3 times nominal GDP growth. And this, of course, is of significant concern to the central banks, notably the Federal Reserve and the European Central Bank. This chart shows you what has happened in the tightening that has gone on by the Federal Reserve since June of 2004, and with the European Central Bank rather more recently. At this time, short term, the policy rates in Europe are at 3.5%. I think that they will go add another 25 or 50 basis points. The Bank of England recently raised their short-term rate to the same level as that of the Federal Reserve, 5.25%. The big question that John Sylvia is going to answer in his presentation on the United States is whether or not the Federal Reserve is going to cut rates, stay where it is, or raise rates. My hopes, and I admit I'm a wishful thinking indicator at this point, my hope is that the Fed will in fact cut rates, keep them where they are for perhaps another 3 meetings, and then begin cutting rates as the housing market begins to bite. But this is a significant component of the outlook for this year, and my optimism, I think, figures and the expectations that U.S. and global growth will do quite well. These are the government bond yields. I have to admit that I have been surprised, together with a lot of professional friends, that how low bond yields in the United States, in Japan, in the euro area got, and how low they have gotten in real terms. This is cheap money. When you look at the real bond yields, these would be the 10-month government bond yields on the right-hand chart. Money is cheap. The historical average in Europe and in the United States has been somewhere between 3 and 4% for the real cost of long-term money. So money is cheap, and we have to hope that it continues this way. One of the concerns of the central banks is that the other components, here we go, the other components of world financial conditions are share prices and credit growth. Share prices, as I indicated, since the beginning of 2003, have risen sharply. You all have made a lot of money in U.S. equities. If you were invested in Europe and Japan, you made even more money. Also the demand for credit, because of strong economic growth, because of reduced sense of risk, has led to very strong credit demand. So the central banks, the Fed and the ECB, are now looking at these components of financial conditions and saying these are very easy indeed. We may have to slow things down. Exchange rates. This is where you can really lose a lot of money. I have been extremely fortunate in the past 2 years to have forecast the year-end rate for the dollar-euro rate within 3% of what actually happened. That was extraordinarily lucky. It will not happen again in my lifetime. However, the line of reasoning, I think, right now is that the United States looks pretty good to international investors. I think that the interest rates in the United States will continue to exceed those in Europe, certainly in Japan, for the next 3 to 6 months. I think that the equity market's behaving very well here in the United States. I think the capital will start coming back here. And therefore, from the time that I wrote my year-end forecast, when the dollar to the euro rate was $1.31, I think we could see $1.18 by the time we get to the end of the summer or the autumn, before the dollar begins to weaken. However, the long-term trend for the dollar is clearly down, but over a long period of time. Fundamentals such as the current account deficit, such as relative growth rates, really don't have a great deal to do with the short-term exchange rate fluctuations. It's the differentials in your short-term interest rates. Europe, I mentioned, has typically been a disappointment, especially to those of us who live and worked in Europe for a long time. Young people of the sort that we were talking to earlier this morning are very disappointed and bitter about the job situation. But this chart shows that, in fact, the Europeans are starting to do things because the corporate sector, the private sector, particularly small and medium-sized businesses, have been emphasizing productivity, control of cost, and their profitability has risen very sharply in the past 3 or 4 years. In fact, I have almost tripled my investment in the medium-sized company index in German stocks in the past 3 years, to give you an idea. As a result of that, job prospects, hiring plans by these companies in the euro area, that's 12 countries in Germany, are doing much, much better. And as a result of that, we see a sharp pickup in confidence in Europe, which is very heartening indeed. Business confidence on the left-hand side is, as you can see from the euro area, the top line has improved dramatically, and European consumer confidence is also improving. For the world as a whole, the world economic leading indicators, these are stabilizing after coming down in 2005, 2006. And the components of this, which are the European Commission Survey of Business Confidence, Japan's TANCAN survey, and the Conference Board Survey of International Leading Indicators, suggest that we will see this line starting to move up again over the course of the next 2 to 3 quarters, which suggests that not only does this year look pretty good, but the year 2008 will also continue to be quite good. Inflation, frankly, I've been worried about inflation mostly since the second oil shock in 1980-81. Thanks to a 6'3" cigar-smoking guy named Paul Volcker, in 1980 who put the Fed funds rate up to 19%. We have had an extraordinarily long period of disinflation, slowing inflation, so that we're now down to an average inflation rate in the industrialized countries of about 2.5%. And I think that's likely to continue. Difficult for me to see with the productivity coming out of China, Asia, and the United States that inflation could soar. You've noticed that we have absorbed a tripling of the energy prices without any significant increase in the underlying inflation. So I am very positive about the inflation picture. Global growth, I think, as I've indicated, we will see these markets continuing to move forward at a sustained rate, increasingly pulled by the Asian GDP growth markets. This chart shows Chinko and the extraordinary rates of growth that they have had, that I think they will continue to have. And remember what I said earlier about it being a political imperative. They must generate those 19 to 21 million jobs, or they have a great big political problem. So they will continue to grow. The shift from our GDP weighting to them will increase, and they will increasingly support our growth, which is very good news. I do have to say something negative, and I'm hoping that John will refute me. This is an OECD chart based on 18 industrialized countries' economies, which had a 15% real decline in house prices over a period of 6 quarters. We in the United States are not there yet, but if we should have that kind of a decline, the historical precedents suggest that you might have this kind of a decline in real GDP and real consumption, and we don't want to go there. I just point this out just to remind you. This is one of the major factors, however, in the IMF's fan chart. The dark blue shows where the balance of risk is. The dark line shows where they think the central scenario is, where the economy is going. So it looks pretty good, but the preponderance of the dark blue is below because of the risk of a housing-associated correction. And if it doesn't want to leave those dark blue, there we go, because of the potential for a housing downturn, and because if we're right, but in fact growth is better than we expected, better growth than the Fed expects, together with the global tsunami of liquidity plus a housing downturn, these two things might oblige, or let's say the global liquidity and the asset markets, better growth than expected would cause the central banks to tighten. This in turn would alarm the bond markets, and mortgage rates might rise and trigger a worse housing situation than we had. Those are the principal risks, but as I say, my guess is that those risks, excessive central bank tightening and housing risk, perhaps represent 30% risk. It looks good, and I wish you all well in 2007.
Thank you, Paul, for that positive outlook. Paul and our next speaker have been friends for over 20 years. I believe they met in Boston at a conference, and they are both on the board of the Global Independence Center located in Philadelphia. And this center promotes understanding of global interdependencies, such as the U.S. and the China economy. They cooperate closely with the Philadelphia Fed. And Mr. Horn asked me that I tell you that because he finds it very interesting. Now, Dr. Sylvia is a chief economist from Wachovia Corporation, Charlotte, North Carolina, who will talk about the national economy. He joined Wachovia in February 2002 as the chief economist. Previously, he worked for Capitol Hill and was the chief economist for the U.S. Senate Banking. And he was the senior economist for the U.S. Senate Joint Economic Committee. Prior to that, he was the chief economist for the Kemper Funds and managing director of Scudder Kemper Investments. He holds a bachelor's degree and a doctoral degree in economics from Northeastern University in Boston, a master's degree in economics from Brown University. Please welcome Dr. John Sylvia.
Well, thank you, and good afternoon to everyone. Last night we had a great dinner at the Greenwoods. It was really a very gracious dinner. In fact, I knew it was so neat that I took some of the silverware home with me and I'm going to use it in my own house. So impressed. It was cool. I loved it. The other irony last night that was kind of funny, and maybe some of you have caught on already, is that when you've got someone named John as a speaker and someone named Paul as a speaker and someone who looks like Ringo as a speaker, it didn't take long for some of the people last night to generationally comment about the relationships. And those of you that also have a very good memory, you'll also notice that the Beatles did record a song called Julia on one of their albums. So it's kind of an interesting thing last night when people started talking about that. In terms of economics, my focus is primarily on the domestic economy. And so the challenge for decision makers, whether in the public sector or in the private sector, is whenever you're doing your strategic planning, you have to make a decision on 5 basic economic expectations. And oftentimes, remember, economics is driven by expectations. It's not driven by what happened, but basically what you expect to happen. And our expectations are primarily driven by growth, inflation, what we expect with respect to corporate profits, what we think about is going to happen with interest rates, and then finally currencies, which of course Paul has covered. So we'll begin the discussion this morning with looking at sustained economic growth in the economy. What do we expect to happen? Basically, the overwhelming majority, as Paul indicated in one of his graphs, is that the majority of economists expect continued economic growth slightly below trend and definitely below the pace of the last 3 to 5 years. So that's the general expectation. Yes, we have growth, and growth will continue to move forward. Now, when we look at the distribution of growth, that is very different. And what you see here is the residential investment or the housing sector subtracting from the overall pace of the economy. So yes, housing is a drag on the economy. It is subtracting from the pace of growth, but it doesn't cause a recession. Housing in the United States is basically 5 to 10% of GDP, 5 to 10% of the overall growth of the economy. It doesn't dominate the economy. It might dominate the media headlines, all right? It's great to talk about at cocktail parties, but it does not dominate the overall economy. So what you have here then is an economy growing slightly below trend, in part because of the housing price correction that goes on in the overall economy. Now, what really matters for the overall economy, as many of you know, is the consumer. And Economics 101, consumption is a function of income. It's not credit, it's not debt, it's not wealth, it is income. And what you see in the graph here, as shown, is that income spending continues to be very, very solid. Not as strong as it was last year, but it is very, very solid. Very important points, and in fact, as Paul alluded to this morning in the question and answer period we did with the students this morning, one of the comments was about wages. Remember, wages and salaries in the United States are only about half of income in the United States. Not surprised to some people, but it is very, very true. If you don't believe that, go to Florida. Okay, you meet a lot of people in Florida who spend lots of money and they don't have any wages and salaries. What has happened is the American household in general has really diversified their sources of income over the last 20 or 30 years. So once again, wages and salaries only about half of income. And remember, wages are only part of the compensation to workers. Those benefits are getting spent. And if you don't believe that, talk to your spouse next time you go to the doctor's or the dentist's office. Okay? You are spending your benefits, so it is real income. It is being spent. So again, consumers continue to move forward. Job gains are pretty solid. Wage gains, compensation gains are very solid, especially for those people in the professional services categories, IT, finance, leisure and hospitality. Those wage gains, those compensation gains are actually pretty darn solid. So you have an American consumer continuing to move forward, continuing to spend money, right? You and I both go to the mall and wonder how these people can possibly afford all this stuff, but they're buying it. All right, so again, consumer continues to move forward, and that's a driving force in this economy. The next element of the economy is investment spending. And for those of you that may not have heard the report this morning, durable goods orders in the United States came out very strong this morning when the data was released. And if you notice in this graph, it says that capital goods orders, spending, investment is very strong, continues to be strong. Perhaps it'll slow down in the next year or so, but it continues, again, to add forward momentum in the economy. And you remember, investment spending is about twice as important as housing in terms of contributing to overall growth in the U.S. economy. So again, very, very important capital goods spending. One other point I wanted to make clear, when you look at manufacturing, and all of you hear about manufacturing going abroad, not at all true. What you need to differentiate is durable good manufacturing and non-durable good manufacturing. When you talk about non-durable goods, you're talking about textile, apparel, food and beverage production. But when you look at the durable good manufacturing, we produce more durable goods today by about 25% than we did at the peak of the dot-com boom. We produce more semiconductors, more computers, more industrial equipment, more farm equipment, more electrical equipment in the United States by over 25% relative to what we did at the peak of the dot-com boom. So manufacturing, you need to split durable versus non-durable manufacturing. We are globally competitive in producing durable good manufacturing type goods. All right? It's the non-durable goods that are much more under pressure. Here you have non-residential construction. You can see a huge recovery in the last year or two on non-residential construction, and then we expect a modest slowdown going forward. A lot of this non-residential construction is basically office buildings. And you can just go across the street and see what an office building looks like. Okay. What drives the office building, what drives the healthcare medical center is the consumer, is employment in the service sector. So there are some fundamentals behind putting up these buildings. Okay? They're not just speculative building. Office employment in the United States is very strong, and healthcare spending continues to be very strong in the United States. I like to use this graph to illustrate about the housing issue. Oftentimes, people think about the housing bust, and immediately they go to California or they go to Florida, and they say, well, that's where the prices are going to collapse. Not at all true. This is the latest data from the Federal Housing Enterprise Office, and you'll notice where are the weak spots in the housing market in the United States. It's not Florida, it's not California, it is the upper Midwest. Right? When you look at the bottom 20 housing markets in the United States in terms of home price appreciation, 17 are in 3 states, Michigan, Indiana, and Ohio. Huge restructuring going on, huge demographic movement. A lot of young people moving out of those states, moving south somewhere. And so when you look at the housing market, it's the demographics that drive things more than anything else. Again, looking at some of the data, for example, you'll see that Oregon, Washington, and Utah, Arizona, those 4 states are in there. Those are all escapees from California. But notice you've got North Carolina and South Carolina in there. What's the North Carolina city or area? Wilmington. What's the South Carolina area? Charleston. So you can see that there's a strong movement, migration, especially for retirees, towards the water. They want to be on that ocean front. They want to have that property. So demographics, the movement of people across this nation, is a hugely driving factor that determines home prices. If you want to know whether the price of your home is going to go up in the next 5 or 10 years, figure out if people are moving to your city or not. If they're moving, your price is probably going to go up. If they're not moving into your city, the price is probably not going to go up. Again, that's a huge challenge, and a huge challenge to the conventional wisdom of thinking. This is the second phase. This is the inflation story. And this is going to be really, really neat. Next week, on the 31st, 2:15 in the afternoon, the Federal Reserve will announce its monetary policy decision. And of course, we know Yeager here is going to tell us what that decision is going to be in a few minutes. But seriously, that's what you want to listen to, because here's what the challenge is. As many of you may know, President Lacker from the Richmond Fed is leaving in terms of losing his voting position. He's staying on the Fed, the FOMC, but he's not a voting member. Now, he was the guy who had the dissent in favor of higher interest rates for the last 3 or 4 meetings. What will be interesting next, on the 31st in the afternoon, 2:15, okay, you can all write that down, all right, at 2:15, is there going to be a dissent? Will there be anyone at the FOMC who wants to register a vote in favor of higher interest rates. And what Lacker's point was, if you look at this graph carefully, you'll notice the inflation number is stubbornly staying above that 2% ceiling. And from the Fed's point of view, the question is, well, if we allow that inflation number to stay where it is for a long period of time, then those inflation expectations will get embedded in business decision making, and we really don't want that. We want to bring that inflation number down a little bit. So what we want to see, all right, on the 31st at 2:15 in the afternoon, when they make their announcement, is how tough are they going to be on inflation? Because then you get to the next point, which is the federal funds rate. This is your interest rate story. What interest rate do I expect over the next 6 months to a year? And a lot of that's going to reflect what you expect on inflation or what the Fed feels is a tolerable inflation number. So you can see some of these decisions are definitely getting intertwined here. Right? And the 31st is going to be key. February 14th, for those of you that don't remember, that's Valentine's Day. But for economists, it's even more important than that, because supposedly Bonnie and Ben are going to get on together in Washington on Capitol Hill, and they're going to discuss monetary policy. This is the semi-annual monetary policy hearing. So Ben Bernanke, who's chairman of the Fed, is going to discuss his wonderful relationship with Bonnie Frank, who's the chairman of the House Financial Services Committee. And out of that interesting relationship between those two characters is going to determine your entire economic future, because they're going to figure out what growth rate can we tolerate, how much inflation can we tolerate, and whether the Fed raises interest rates to offset that inflation number. So remember, although February 14th is Valentine's Day, that's really not the important event of the day, okay? It really is the Ben and Bonnie show. So focus in on that, and we'll be okay. A huge challenge, as many of you probably realize, is the flat or, in fact, inverted yield curve. So as far as interest rates go, our expectation is that inverted yield curve will stay in place. That short-term rates will stay above long-term rates probably through the end of the year. That is a huge challenge. For those of you that may have noticed, for example, Wachovia, when they came out with their earnings in the last week or so, said our net interest margin went down. We're getting squeezed, all right, because a lot of the loans we make are longer term, a lot of the borrowing we do is short term, and again, those short-term rates are still higher than the long-term rates, so our net interest margin is getting squeezed. That's an important challenge to most of the banking institutions in the United States. How are we going to deal with a yield curve that's protracted, that lasts a longer period of time? Really an interesting challenge to financial institutions in the United States. Historically, we've not dealt with that. Historically, if the curve is inverted, we have a recession right away, and 3 to 6 months later, we move on. All right? But that's not what's happening right now. And that I think is really key, really interesting. But of course, I'm an economist, and I find a lot of strange things interesting. The other thing that we need to talk about, though, is the idea about foreign investors buying U.S. assets. And we can see in this graph really strong interest. Again, one of the questions this morning was about mortgage rates. And why is it that U.S. mortgage rates appear to be continually fairly low, right, relative to what we experienced in prior cycles? And one of the driving factors is foreign buying of U.S. financial assets. You can see in the graph that foreigners, that top line there, foreigners love to buy our corporate bonds. Okay, Wachovia has an office in London and Paris. Sometimes we admit we have an office where the French are, but we also have an office in Beijing and Hong Kong. And those offices, in the United States, if you look at the data, we sell about 40%, 45% of corporate bonds abroad in the United States. And those offices are incredibly busy. We sell mortgage-backed securities, agencies. So when you're complaining about the foreign investors, remember those foreign investors are helping keeping short-term interest rates low. And that sets up one of the risks that Paul was alluding to, okay? So again, John, Paul, Ringo, Julia, okay. One of the risks that Paul was alluding to, because if the foreigners start withdrawing some of that money, it's not going to mean a collapse in America, but it does mean higher interest rates in a lot of different instruments. And there's finally corporate profit growth. And this is another one of those interesting problems. If you notice in the diagram fairly carefully, profit growth seems to zoom after every recession. And that is typical business cycle. Top line sales go up, costs remain fairly low, profits, which is the difference between the two, tend to move fairly dramatically. And you saw that, for example, in this diagram in 83, 84. You saw it again in 92, 93. And you saw there's a second peak. What is so different this cycle is that third jump in the corporate profit numbers. Now, we can go through a lot of details here about corporate profits. But what is really interesting is to think about how sustainable is profit growth at a faster pace. For those of you that ever watch CNBC in the morning, almost all of the debates among the equity investors or the strategists is what are we to expect of the pace of corporate profit growth at this stage of the cycle? Because we're into the cycle 3 to 5 years already. Okay, we've had an expansion for a long period of time. Usually profit growth is much slower. You can look at the 82, 84 experience, look at the 95, 96, 97 experience. Profit growth should be much weaker. It should be positive, but it should be weaker. And why isn't that happening? You know, what part does globalization play? What part does the changing structure of the American economy play? Really fascinating stories, well, fascinating for an economist, but really fascinating stories for economics in general. And that's my staff, and that's it for my presentation, and thank you for listening.
Thank you, Dr. Silver. For once, I'm going to be looking on February the 14th for the Ben and Barney show. But gentlemen, I would suggest you think about something else on February the 14th also. Well, I think the outlook is positive, and I'm real pleased as a banker, as a community banker. I'm real pleased about this. I'm going to go home with high hopes. Dr. Yerger is going to give us more of a state and local economy report. It's my pleasure to introduce him as the Arkansas Bankers Association Chair and Associate Professor of Finance, and he's going to talk about local, state, and regional economy. His responsibilities include teaching, research, and outreach to Arkansas community bankers. Prior to joining the Walton College in January of 2006, he was an assistant vice president over the Supervisory Policy Analyst Unit of the Federal Reserve Bank of St. Louis. He received his doctorate in economics in 1993 from Washington University. Please help me welcome Dr. Yerger.
Thank you to all of you. I am very glad and happy to be here. And I need to thank Mary Ann Greenwood for her wonderful hospitality last night. I've never seen so much silverware at a table setting until, of course, the economist ran off with it. I need to thank Dean Worrell, who asked me to speak this year to the local economy, or about the local economy, to all of you. And finally, and most importantly, I need to thank Kathy Deck and all the people at the Center for Business and Economic Research who are really coordinating this entire event. And even though my mouth is moving, much of Kathy's brain is in me, telling me what to say, in a sense. So with all that, I really appreciate being here. Ringo is not a name I had heard myself called before, but I kind of like the tone to it. It's kind of nice. I don't think that I look like a rock and roll drummer, but maybe I'm wrong. You can decide. Well, what I want to do is I'll start with the very beginning. Oh, and by the way, just as one last side point here, yes, I did work at the Federal Reserve, but unfortunately, no, I don't have any more control over interest rates, and I'm not so sure I ever did. I will say, however, just as somewhat of a tangent, the federal funds futures market for the entire 8 years I was at the Federal Reserve Bank, the federal funds futures market called rate changes, to the best of my knowledge, correctly every single time. So the market knew as well as at least the relatively uninformed people at the Fed about what was going to happen to interest rates, what was going to happen at the next meeting. So pay attention to those futures markets. They can be a great source of information. Okay, well, let me get right to the takeaways. And what I want to do is really go over three themes that I'll hammer on. Number one, the loss of manufacturing jobs and some other things slowed the Arkansas economy somewhat during 2006. So the economy actually slowed just a bit relative to the nation last year. I'm going to make a bold prognosis that the state of the economy in 2007 for Arkansas will depend upon the national economy, okay? So you have to go ask other folks what is going to happen with the national economy. I tend to agree with their viewpoint. I will give you my 2 cents worth. I think we're going to be in for a year of relatively slow growth, but avoid recession. So I think the state is in for similar growth patterns. Finally, the third point I want to give you is that despite the fact that the Arkansas state follows the national economy pretty closely, I'm going to look at 3 different regions, focus on 3 different regions of our state: Little Rock, Fort Smith, and then Northwest Arkansas. And those regions are all very different. And so there is no one economy in the state of Arkansas. There are several economies in the state of Arkansas. In the aggregate, we tend to track the national economy. But if you go down a bit further, there's actually a lot of differences in terms of performance. So let me start with that. And if we take a look at employment growth, this is the economic slowdown I was talking about. In employment growth, what we're doing here is looking at Arkansas and U.S. employment growth during 2006. My data on Arkansas go through November, and there were some additional data and modifications later on that are not incorporated in here. Nevertheless, state employment growth dipped somewhat towards the latter half of 2006. And not surprisingly, unemployment rates ticked up. So while Arkansas's unemployment rates were lower than the national average in the beginning of 2006, they crept up above it and have remained above the national unemployment rates for the latter half of the year. Now, it's not a lot above, and the Arkansas unemployment rates are still quite good. But I think it is something that deserves at least an attempt at an explanation, and so that's what I'll try to do here. Why did the Arkansas economy slow down in 2006? Well, if you can, to the extent you can read this chart here, non-farm employment in 2005 in the state of Arkansas increased by 16,700 jobs. In 2006, that number was 10,100 jobs. So there was a growth of 6,000 fewer jobs. Why was that? Well, we can blame manufacturing to some extent, and the very last bar of that chart is manufacturing. Manufacturing declined by about 2,000 more jobs in 2006 than it did in 2005. So we're losing manufacturing jobs, and the pace of the slowdown is not slowing down. In other words, the pace of the slowdown appears to be even increasing. But the other 2 factors that went on here, number one is, you look at construction jobs, they went from 2.7 or 2,700 jobs, new jobs created, down to 1,000 new jobs created. And the government sector went from 5,000 to 1,000 new jobs created. So the slowdown was really a story about continued manufacturing decline, a little greater than the average, at least from the last year, and government slowdown and construction slowdown. Now, the government slowdown, I'm not sure exactly why that happened. Maybe it was an off congressional year, I don't know. But it did contribute somewhat to our slower economic growth and our higher unemployment rates. Okay? Now, the question number 2, the second of the 3 questions I want to address, will the Arkansas economy continue to slow down in 2007? And the answer here depends upon 2 factors. Number 1, the performance of the national economy, which I alluded to earlier. And number 2, how closely related the state economy is to the national economy. And that's the issue I want to address right now. Now, what's going to happen in the U.S. economy? Okay, well, as any good forecaster will tell you, and you notice that John and Paul did a really good job of this too, you don't be too specific, right? You have to leave it a little bit vague. So how is the economy going to do in 2007? Well, the United States economy is throwing out mixed signals. We have high oil prices, but they're falling. And it's not clear that they're going to shoot back up again. So maybe we're getting some of the benefit from oil prices falling somewhat. We have an inverted yield curve, but the long rates have been low and been stable. Again, those are offsetting forces for the national economy. Finally, we have a sluggish housing market, but we have strong consumer spending. And it used to be the definition of, what is an American? Well, and this is certainly changing, but it used to be, well, it's someone that speaks one language, right? You're not bilingual. And the other definition of an American is someone who doesn't know how to save. So we like to spend our money. And consumers certainly have been spending and generating a lot of economic growth. Okay, how closely linked are the national economy and the state economy? Well, this next chart I have here shows that GDP and GSP, gross state product growth, are highly correlated. They're not exactly identical, but they're very similar. When the nation tends to grow quickly, Arkansas tends to grow quickly. You see in 2001, the recession year, the U.S. economy grew about 1%. The Arkansas economy barely grew at all. But then growth rates have picked up since then. Okay? Related to that, if we look at employment trends, the Arkansas and the U.S. employment growth are also highly correlated. And you see these charts very intermingled here. You also see the slowdown right towards the very end of that chart in 2006, and that's that growth slowdown that I was talking about right at the beginning, how the Arkansas economy slowed somewhat more than the national average in 2006. Okay? If you focus on the other side of the employment situation, you focus on unemployment rates, you will see that they are closely correlated as well. Okay? Again, in 2006, the Arkansas economy and the unemployment rate jumped up more than it did for the nation, and so we again have the evidence of this slowdown. But there's some differences that stand out that I think are important to note. Number one is, if we take a look at where employment is generated within the United States and within the state of Arkansas, we'll see a lot of similarities, but there's two big differences. These are the major categories. I don't have all of the categories here, but I certainly have the major categories of employment. And you see that professional and business services are 12.9% of the economy for the nation, of employment for the nation, 9.8% for Arkansas. So we're not as heavily invested in professional and business services on average. We make up for that in manufacturing, okay? And so we have heavier reliance on manufacturing in employment compared with the nation, 6 percentage points higher, all right? So what does that tell us? Well, we actually may be more cyclical on average than the nation is. Moreover, the heavier reliance on manufacturing, especially, as John alluded to, the non-durable goods manufacturing, has been disappearing. And the very bottom row of that chart shows that between 2000 and 2006, Arkansas has lost 20% of its manufacturing jobs. Okay? That's a remarkable decline in just a 6-year period. And so the future doesn't, nor the present, really bode well for laborers who are working in these non-durable goods manufacturing sectors. And the question is, our overall unemployment rate has not changed much over that time. So clearly these people are either leaving the state, but I have demographic charts to show that that's probably not the case, or they're working their way into other sectors of the economy. The really big question is, what are their wages looking like as they go from these manufacturing sectors into service or other types of employment sectors? Are they able to recoup the wages and the benefits that they lost? And I would assert to you, in many parts of our state, especially in the rural parts, the answer is they're probably not able to recoup those wages and salaries that they once had. So they're forced to move somewhere else or accept lower paying jobs. Okay? And this is a structural issue. Yes, it's maybe hitting Arkansas more than the nation as a whole, but this is a nationwide issue that we've been dealing with for 30 years, and it's just continuing that trend. All right. I was going to talk about population. Here's a simple chart, just shows population growth for the U.S. and for Arkansas. And Arkansas's population grows about the same as the U.S. population. In the last few years, the population has grown somewhat faster. Okay? And a lot of that, I'm sure, is driven by Northwest Arkansas, and we're going to get to that in just a moment. The other maybe positive factor for the state is that you can look at it two ways, I guess. We're not on the coast, so we don't have as many people flocking to our state to buy the beachfront property, right? Unless you talk about Beaver Lake, where prices are way too high, you know, especially for someone who doesn't own property on Beaver Lake. And however, the good side of this is that we don't get the cyclicality in the housing market that we will get in other places, okay? And so you can see for Arkansas and the nation as a whole, existing home sales peaked in late 2005 for the nation, and they've fallen somewhat since then. For Arkansas, again, as a whole, we've seen modest but continued growth in existing home sales. And we're going to take a look at some price data a little bit later for Northwest Arkansas, which at least was a bit surprising for me. So if I sum up the state of the state, Arkansas and the United States economy are closely linked. The heavier dependence of Arkansas on manufacturing might be offset somewhat by a milder housing contraction. And again, my bold prognosis here, we're going to do on average about what the United States economy does, okay? The problem is that focusing on the state as a whole masks a lot of the really profound differences across the different microeconomies, the different MSAs that we have here in the state of Arkansas. And I'm going to focus on the largest of the three MSAs. We'll look at Little Rock and North Little Rock. We'll look at Fort Smith, and we'll look at Northwest Arkansas up here in this region, where most of you are from. And fortunately, because of the help of Arvest Bank and the Center for Business and Economic Research, we have fairly good data. We have a lot of good information. If we take a look at where employment is coming from, and I remember the former director of the Center for Business and Economic Research, Jeff Collins, who gave this talk last year, showed a very similar slide. And you know, I was new to the state actually at that time, and so a lot of what he was saying was very new to me. But it struck me how much of the state's economic growth is being driven by Little Rock and Northwest Arkansas. And this table that I have here really highlights that fact. Of the almost 3,000 jobs, 103,000 jobs created over the last 10 years in the state, if you look at the aggregate numbers, 61% of those were formed here in Northwest Arkansas. Another 35% were in Little Rock, okay, and the surrounding MSA. And then 4% came from the rest of the state, okay? Now, I'm not going to talk a lot about the Fayetteville Shell, in part because I'm not certainly an expert on this. But one of the nice things about the Fayetteville Shale is that this is going to be a source of revenue and to a lesser extent, a source of job growth and income growth for people who live more in the rural areas, especially north central, northeast parts of the state, okay? And this natural gas production that is still just getting generated, getting cranked up, is expected to generate perhaps $5 billion in revenue in the state of Arkansas over the next couple of decades. Now, these forecasts are wild and they're uncertain because we don't know how much gas is down there. We don't know what it's going to cost to tap into all these things. But imagine that December 31st rolls around and your boss all of a sudden drops you a $1 million bonus check and you weren't expecting it, right? Well, that's in some sense what the Shell project is like. It's really unexpected revenue. We didn't expect it 5 years ago. And now we have this revenue that really can give these rural areas a boost. If those funds are invested wisely, can lead maybe perhaps to more sustainable job growth in those areas. Okay, so Little Rock, North Little Rock really dominate, along with Fayetteville, Springdale, and Rogers. And what I'm going to do is show two charts for each of these regions that are similar, and then you can see really what the differences are. And I focus on the labor data because that's the best data we have. And so if you look at Little Rock, you see in the top half of this chart up here, non-farm employment growth in the thousands. And it should not be surprising that this employment growth trend looks a whole lot like the United States employment growth. Because Little Rock is a mature, diverse economy. They tend to reflect very much what the United States economy is doing. And in the bottom half, we see employment growth by year for the years 2001 through 2006. Well, Little Rock went through a recession in 2002 in terms of employment. But it has been slowly but ever increasingly growing and recovering from that recession. And so if the U.S. economy remains strong, I have no reason to doubt that the Little Rock economy is going to remain strong. Okay? If we look at where employment comes from in the sectors, then what we will see is, and if we focus again on the very bottom row, that in manufacturing, while 10.4% of the United States labor force works in manufacturing, only 7.3% of the Little Rock, North Little Rock area works in manufacturing. So they're less dependent on manufacturing than the average. Where do they make that up? Well, it's in government, right? Which people can debate that's better or worse. But certainly the government is more stable as an employer, and they tend to offer better wages and better benefits than do a lot of these manufacturing jobs that are under intense international pressure. So the Little Rock economy is healthy, it's diverse, and they reflect the national economy more than anywhere else in our state. Fort Smith. There's a lot of good things going on in Fort Smith, and I had the chance to sit next to some people from Fort Smith yesterday and learned about a lot of the initiatives. But the overriding challenge of the Fort Smith economy is still to deal with the manufacturing sector that is under such intense pressure. And this is not a short-term project. This is a long-term project. Fort Smith has been dealing with this. I will say, I don't want to be doom and gloom on Fort Smith, because if you take a look at non-farm employment, 2004 and especially 2005 were very good years. Fort Smith did quite well, and Fort Smith can generate growth. It's not going to come naturally, however. That growth is going to come from a lot of people working together, putting their heads together, a lot of people having a vision, raising the resources, carrying out that vision, attracting high-quality labor to the area, okay, or retaining the high-quality labor in the area. So it's going to take an effort, and without an effort, it's not going to happen naturally. Without effort, Fort Smith is going to continue to have very modest or negative growth, and they're going to be more vulnerable to business cycle contractions because they are dependent on the manufacturing sector so heavily. And if you take a look at, again, the bottom row of this Fort Smith employment graph, what you see is that manufacturing accounts for 21% of Fort Smith employment, double the national average. Okay, so there's challenges here. And Fort Smith is going to have to work very hard to resist this negative pressure and overcome this negative pressure. Okay, the last sector that I'm going to talk about is Northwest Arkansas. Before I came here to the university, to me, of course, Arkansas was a place with a better climate than Missouri, where I came from. But it was one uniform, what's the way to say it, picture that I had in my mind of what the state was like. And I have quickly come to realize, even just from my first visit here, that the state of Arkansas is extremely diverse. And different sections of it are very, very different than other parts. And Northwest Arkansas has been the engine of growth in the state for quite some time and will continue to be that engine of growth going forward. We have a lot of things that have come together in the right place in the right time, generating lots of jobs, generating lots of employment growth, and we have anchors here, obviously. We have the retailer anchors, we have the transportation anchors, we have the university, we have just a tremendous amount of dynamic activity that's taking place. And, if you would have come to Rogers in this particular land site probably 3 years ago, it wouldn't be anything like it is today. So we have seen just tremendous growth. And really, if you would have come here a year ago, you wouldn't have seen nearly what you see in this area today. So it's a dynamic economy, tremendous growth here, and lots of opportunities for the future. So if you take, let me back up. If you take a look at employment growth in Northwest Arkansas, this chart here might understate it somewhat, but I actually had to change around the fonts and the alignments of the graphs because the numbers are so high. Right? Little Rock was at 2% growth, and that was about the highest it achieved. We have numbers here in the 5% and at least in the high 2s. And 2005, 5.33% economic employment growth, 3.22% in 2006. The other thing to note is that you see absolutely no cyclical trend in Northwest Arkansas's economy whatsoever. Okay? Now, I did smooth out some of the month-to-month fluctuations, but you see a straight line of growth. And the economy has been recession-proof, and I think will remain recession-proof for some time to come as this dynamic growth engine continues to play out. Now, one thing that surprised me somewhat is the relatively high reliance on manufacturing, even in Northwest Arkansas. And if you look at employment shares by sector for Northwest Arkansas, we have 15% employment in manufacturing. But I will submit to you that there's two differences between our reliance on manufacturing, the heavy reliance on manufacturing here, relative to that of Fort Smith, or maybe three differences. One is it's still 5 percentage points less. But secondly, if you look at the top row bar, the trade, transportation, and utilities, you'll see that we have far more retail trade activity, which is not surprising, far more transportation, which is not surprising. We also have more educational and health service, more professional and business services than does the national economy. So we're producing a lot of service jobs here, a lot of well-paying jobs, and anyone who drives casually through Benton County basically will see that many of the houses that are going up and being occupied are very nice houses. These are people that are moving to this state and this portion of the state because they have high-paying jobs and they have good benefits. Okay? So the future looks very bright for Northwest Arkansas. Now, thanks to, if I can get this up, thanks to, again, Arvest Bank and its sponsorship of the Skyline Report and the Center for Business and Economic Research that puts it all together, we have a little more information we can share. And a lot of metropolitan areas, even areas like Little Rock, do not have such detailed information. I'm going to give you some of the nice aggregate overview here. But if you take a look at the complete but unoccupied homes in Northwest Arkansas, we're up to about 3,000. So we have 3,000 homes that are built, no one's living in them. This is despite the fact that we have almost 1,000 new homes, or 1,000 homes that are newly occupied in the state each quarter. Okay? So we have a lot of people moving in, but the housing supply has offset that pace. And so you can think about the darker line here as the supply, and you can think about the lighter line, the dashed line, as the demand for housing. And demand has far under-exceeded supply, or they put it the other way, supply has far outpaced demand. And so we have a lot of unoccupied homes. However, take a look at the next graph. Washington County home prices did dip somewhat in 2006 on average, but they've recovered toward the end of the year. And Benton County average home prices didn't miss a beat. Okay, they just kept marching right on up. Now, I think that the price data, especially on new homes, masks a lot of the hardship that's going on. There is hardship out there, and there are construction firms who can't pay their bills, and there are people who are planning to build subdivisions that have canceled all plans, stop construction in midstream because it no longer makes sense. There's a lot of hardship. It's not reflected in the price data, I think, because when you're talking about new homes, you tend to sell at cost plus a markup, right? And you're not going to suffer an immediate loss on a home, on a new home, when you take into account everything you put into it. So the price data are somewhat misleading, okay? But I do think eventually supply and demand will come back in balance. Probably going to take a couple of years. I wouldn't expect it to happen next year, or I should say this year, or probably in 2008. Okay, but it may happen sometime after that. And it requires the builders to slow down their building pace, maybe even stop their building pace, and let the demand catch up. The demand is strong, and the demand will catch up. So this is not going to be a permanent glut of houses. Finally, how much will the housing slowdown sort of take Northwest Arkansas off track? I don't think it's going to take it off track much at all. I think maybe a percentage point of employment growth, which is noticeable, but when you go from 5 to 4, you're doing well, right? You're still doing well. And one chart that helps to demonstrate this point is a look at commercial real estate growth. We have vacancy rates for office and for retail commercial real estate. Despite the incredibly high growth of commercial real estate construction in Northwest Arkansas over the last several years, this chart here shows that the demand is keeping right up. There's no glut in office space. There's no overbuilding to date of commercial real estate. And again, a cursory look around will tell you that this economy is healthy and vibrant, and I expect it to stay that way for some time to come. So the engine of growth in our state will remain Northwest Arkansas. The difference is that the engine is now driven largely by commercial real estate, less so by housing construction. But it's still large enough and solvent enough to keep this economy on track, absolutely. Okay, so with this, I'll conclude, and let me just reiterate my 3 points. The Arkansas economy will largely track the national economy in 2007, but that masks the diversity of those 3 different MSAs that we talked about. It also masks the revenue boom that we're going to see in natural gas production in the state. Little Rock is going to follow the national average, maybe a little less variance. Fort Smith will continue to suffer manufacturing losses, and it's going to be more of an effort, more of a challenge. And commercial real estate growth in Northwest Arkansas will offset any housing slowdown that we have. Thank you.
We want to thank these group of men here on this panel. I think we're very fortunate to have the caliber of information that we've gotten today, and it's okay. I feel very positive, and thank you very much. We do have some, okay. Well, it's going to take me a while just to go through here. We have more than I thought, so I'm just going to start off with the question and give me time to peruse this. Do you think the oil prices will continue down or remain in a range or go higher? John?
Is this working? Yeah, it is. Thank you. Yeah, I would expect that the price of oil right now is pretty stable. I think, 48 to 52, maybe 55 is a reasonable range for this economy over time. I think it's consistent with global economic growth. So I'm pretty, satisfied with the current range of oil prices. Did I give you enough time?
I think that's great. Thank you.
Yeah.
All right. There's a lot of interest in the yield curve. Your chart showed that there was a inflation rate of 2%, and that you expect the yield curve to remain inverted. do you think the Fed is going to be satisfied with today's restraints, or are they going to do something different? I mean, I understand that it's
I suspect that the Fed will leave the federal funds rate pretty much where it is. They have an inflation rate that's at or near their target. They have an economy that's growing perhaps slightly below trend, but this is, again, a real key element in the overall economy, and it goes back to something that Ringo had to say here, that what is the potential growth rate of the economy reflects labor force growth and productivity gains, and those are two very, very strongly debated issues in the U.S. economy. With respect to labor force growth, and particularly participation rates and jobs, overwhelmingly, if you look at the data for the last year, when you're looking at, let's say on average, each month we create about 140, 150,000 jobs in the U.S. economy, almost all of those jobs are service sector jobs. Now, that's not to say that the manufacturing sector is not doing well. The sector itself is doing well. We're just not hiring a lot of people to work in that sector. But when you look at the overall economy, what Ben and Bonnie are going to debate in part is what is our potential growth rate. And Bonnie Frank is going to say, geez, it should be something like 3%, 3.5%. We should be creating more jobs in the economy. And what Ben Bernanke is going to say is that might be true, but when you look at the wage or labor market, we still have a lot of pressures in this labor market. You look at the average hourly earnings compensation gains, we have pretty strong compensation gains in the United States. We may be running at full potential now at 2 3/4 or 3% GDP. So that's going to be one of the tensions you want to listen to on February 14th, which of course, as all of you know, is a very important date because of the monetary policy hearings.
absolutely, absolutely. Dr. Yeager, what steps are in place or being considered to close the economic gaps and disconnect between Northwest Arkansas and the rest of the state? What steps are in place or being considered to close the economic gaps and disconnect between Northwest Arkansas and the rest of the state?
There we go. That's an excellent question. And I have to say, I'll be honest up front, I don't have good answers for that. I think what it's going to take is the communities that are finding the ability to generate economic growth more difficult, coming together and trying to attract durable goods production. For instance, we have a real possibility of getting a Toyota plant near Memphis in Arkansas, so that would be wonderful. If we can get durable goods productions in other parts of the state, if we can get more high-paying service jobs, financial services, whatever type of jobs they might be, that is what we need to really level out the economic activity in this state. I think if I had the answer, then I could make a whole lot of money. But this is a really difficult question, and there is no one easy answer. And so I'm afraid it's going to take a whole lot of people that are a lot smarter than me to put their heads together and come up with strategies to do just that. And there are some things that are in place right now that people are talking about these things. People are thinking along these lines. And so it's not going to be easy. It's not going to be overnight. But I'm optimistic that a few years down the road we can make some real progress.
And the other thing too is, Arkansas is not the only state that's dealing with this issue. North Carolina, Georgia, South Carolina are states where you've got significant differentials in terms of economic growth between metropolitan areas. So there are a lot of states that are dealing with this, and the trick always is, how do you help the laggards without penalizing the leaders? And it's a real difficult balance, not only in terms of politics, but also economics. So Arkansas is not alone on this.
Of the 65% job growth from the Fort Smith Regional SMA, what portion is specific to Fayetteville, Springdale, and Rogers individuals? I don't know if that makes... Oh, well, let me pass that down to you.
For Ringo, I'm not sure if it's saying Gringo or Ringo, but Okay, of the 65% job growth from the Northwest Arkansas, what portion is specific to Fayetteville, Springdale, and Rogers individually, as opposed to some of the smaller communities outside the Northwest Arkansas district? The answer to that, I don't know. This is something that the Center for Business and Economic Research may be able to track. My hunch is that probably 90% or more is coming from these MSAs, these cities inside this MSA. But certainly there's other things that are going on in some of the smaller areas. There's a lot of growth in some of these smaller areas as well. Bella Vista, for instance, and these other types of rural areas. And so I don't know. My guess is that it's probably very high, probably on the order of 90%, of which Fayetteville, Springdale, and Rogers are generating the job growth.
Mr. Sylvia, should we expect a substantial currency reevaluation by China during the 2007?
The question has to do with a substantial currency revaluation. My answer would be no. I think China really isn't going to do very much on the currency until after the Olympics. They really need the Americans to go over there and fill the hotels and buy the tchotchkes. And if you have a devaluation of the dollar relative to the Chinese currency, it's going to be very expensive for Americans to go over there and buy those Olympic gifts. So I would suspect that if you're going to have a significant movement in those currencies, it's probably going to have to be after the Olympics.
All right. This is an interesting question because it pertains to the front page of the paper today. Ford Motor Company, will they survive? And what about the bonuses for the big bonuses for management? John?
I would suspect that given the political climate, given Dingell's position in the U.S. Congress, I would suspect that, Ford will survive. I don't think they're going to be taken over. You're probably going to get some more significant subsidies thrown their way. Once again, I listen about all these bonuses and everything else. Hey, if the company does well, give them the bonus. If the baseball team does well, they get in the World Series, they get bonuses for winning games. So, okay, give it to management. Management doesn't do well, don't give them the bonuses. But remember, one of these issues, again, the Home Depot question is particularly significant here. Remember, most of the money that guy got was a contract. It wasn't after the fact they gave him a whole bunch of money to leave. All right, so if you don't like A-Rod playing baseball for the New York Yankees, he didn't produce his World Series, okay, what are you going to do? It's a contract. It's already agreed to. He's already been paid. All right, so, okay, he didn't deliver. All right, so Nandela didn't deliver at Home Depot. But you can't go around voiding contracts. Otherwise, you run into a whole different ballgame. It's a very different kind of economic system you want to talk about. But, hey, the guys don't produce, don't give them the bonuses. They produce, let them have the bonuses. It's basic, simple stuff.
Paul, do you have anything to add to that?
Is this it? Yep. I think that John's point is an essential one, and that is that it should be performance related, and I don't think it should be, the performance should be sort of predestined at the point of the hiring. It should be after the fact and recognize the performance. I think we have to incentivize good performance and good governance.
Going to be significant, and it's going to be positive. I know when I was at the Federal Reserve, we tracked a new Toyota plant that went in Evansville, Indiana. And that was an area that was very old manufacturing. The city was in decline. There wasn't a whole lot going on there. People were moving out. That Toyota plant came in and created an initial 2,000 jobs. And then about a year and a half after it opened, they expanded it to another 2,000 jobs. And these were 4,000 very high-paying jobs, very secure with nice benefits. And it has the multiplier effect. And even if you have a 1.5 multiplier effect, you're up to 6,000 jobs created. Now, I don't know, and Toyota has been purposely very private in terms of its plans and where it's going to expand. But I would think that if it's any sort of decent sized operation, we're going to see on the order of maybe 2,000-3,000 new jobs created in that area. So it'll have a very nice impact.
And you notice the subtlety in the argument here. You know, when you talk about Ford at one minute and Toyota at the other, it's not that the automobile industry is struggling in America. It's that the big legacy automobile manufacturers in Detroit are struggling in America. Whereas Toyota can expand, Nissan can expand, Subaru can expand. So again, it's kind of important to really break down, you know, the headline says automobile industry struggling. Not true. Break it down. Figure out who is struggling and why they're struggling and get into some of the details. And I think that's very, very important when you're looking at some of these big macro issues to take that next level down and say, okay, let's look at some of the details and figure out what's really going on here in the automobile industry.
Well, it looks as if they want to play an increasingly influential and hardball role in the economy, and they're using their resources. I had referred to the oil reserves, oil and gas reserves in Iraq and Saudi Arabia. Russia is the second largest known pool of oil and gas reserves, and Europe at this point is counting for something like 40% of their hydrocarbon fuels on Russia. And the Russians have indicated with their hardball tactics with the Ukraine and more recently with Belarus that they are willing to cut off supplies to Western Europe in order to get the political objectives that they desire. And so I think we can expect more of that from Russia. And of course, Russia is an enormous country. So Russia will be an increasingly difficult partner. At the same time, Russia needs us, the consumers, needs Europe, and needs China and India as well. So they have to watch their step, but they will be increasingly a contentious partner to deal with.
Most of the questions that we have really are addressed to Dr. Yeager. I mean, I think they're concerned about the population growth. Can you comment on the demographics, particularly age and Arkansas's population growth?
First of all, if you look at the population growth in northwest Arkansas, it's quite rapid, and I think the SEBR group has estimated 1,000 new people per month, if that's a number that's coming to the top of my head. So we're looking at 1,000 people per month just in this corner of the state. And the people who are moving here are oftentimes the people who are up and coming in their industry. So if they're a vendor or maybe work for one of the Fortune 500 companies here in the area, this is oftentimes a training ground where they're taking on a very important role in their company, and then they go back to their headquarters in Cincinnati or wherever it might be and really move up in their career. So I think the people that are moving here are probably going to be in their 30s, right? A lot of these people are going to be in their 30s. They're going to be starting to get into a high earning phase of their life cycle. We're still on now? Okay. In their life cycle, and a lot of these people have small children, which is why we're building so many schools. One of the things I noticed when I first moved here was, on average, how young the population was. And the university has something to do with that, but it's more than that. I think it's the type of jobs that we're attracting here are for those people who are just beginning to really move up in their career, and these are young, very intelligent, smart people ready to go.
Mr. Horn, your last question. This is the last question. Has a potentially significant change in U.S. involvement in Iraq been factored into your assessment of future economic performance?
I tried to avoid that kind of a political distortion of my already labored
Well, you
reasoning.
noticed I saved it to the last.
You did indeed, yeah. I shall cut and run. I'm afraid that it's almost impossible for me to visualize what victory means in Iraq. I worked in the Middle East 3 or 4 times a year between 1976 and 2001, and my everlasting impression of the Middle East is its complexity. Long before the Russians and the British and the Soviets and the Americans got into the Middle East, it was extraordinarily complicated. They were driven by geographic differences, especially religious differences, resource differences, and that will continue to be the case. And we, in effect, in Iraq and in Afghanistan, perhaps in Iran, are eliminating those sort of lids on the strife that had occurred there. First there were the Russians, then the British, then the Soviets, then Saddam. By removing that lid, it's like sort of taking the lid off a pressure cooker. You let all this stuff bubble around and bubble out. And I'm afraid that we are effectively in for a period of seeking a new equilibrium in the Middle East, which may take quite a number of years, and it will, at the very least, have an impact on the financial market's assessment of the price of oil and gas. And therefore, I would be quite pessimistic about that. I fail to see a political will in the United States to stay the course, whatever that means. I think some people read that as replacing Saddam Hussein as the container, the lid, if you will, on all these sectarian differences. I don't think we will do that. I don't think we can afford it financially or in terms of blood or just political will. So I think we're facing a new equilibrium in the Middle East, but which will be established by them, and that could be a very troublesome process.
Thank you. That's going to conclude our answer questions session, Dean Worrell. I want to say that I've enjoyed being with y'all this afternoon, and it's been a pleasure. Thank you.
Am I on? Okay. I just wanted to take this opportunity on behalf of the Sam Walton College of Business to thank our 3 panelists and our moderator. And how about a round of applause for all 4? As a token of appreciation, we have a small gift for each of them, and they're sort of behind here. So, Julia, here's yours. We thank you very much. Thank you. And let's see, Paul, you. Thank you. And John. You bet. And you know, forever to be known as Ringo, Tim. Thank you. And I believe that. I believe that former Congressman Hammersmith may have a presentation. Is he here? Yes. Congressman?
Well, John Paul has been designated by our distinguished Governor Mike Beebe in conjunction with Chancellor White and Dean Worrell to present you with 2 certificates. Tim, I'm sorry you've settled in here, so you don't get one. I might say that my longtime good friend, Julia Peck Mobley, has moved over to Texas. So Julia, I'm going to suggest to the governor that he get one of these certificates ready for you. You have more pull with him than I do. But anyway, it's my great pleasure to present you with 2, one each, Arkansas Traveler Certificates. And if you'll come up here and accept them from the Dean. It's for Paul Horn. John. Now, these certificates have a great legendary story behind them, a long history. I won't go into it here, but basically the bottom line is it says that we're delighted that you're here with your informed knowledge and that you enjoyed your hospitality, especially a typical dinner by Mary Ann, a typical 8-course dinner that we serve in Arkansas. And the silver. But anyway, we do appreciate very much your being here, and we hope that you'll return every opportunity you get. Thank you so much.
Thank you, sir. Very good.
Well, thank you very much, and we're winding up here, and so what I want to make sure I do is to thank our faculty and staff who've worked so hard on putting this event together. So can we have a round of applause for them, please? And one little housekeeping thing, before we adjourn, I'd like to remind everyone to fill out the evaluations that you have in your, at your table in terms of the entry forms for next year and your evaluations. And so thank you very much for coming. Thank you for your support for the last 13 years, and we'll see you in 2008.